Hello everyone, thanks for checking out my video. Just a quick note, there will be no video next week as I will be busy the next weekend, which includes attending the Moo Fest. So yup, I will see you the following week. Alright, the US stock market has officially concluded the first 6 months of 2024 with last Friday's closing bell. And boy, it had ended strongly with the S&P 500 up by more than 14% and Nasdaq gained a whopping 17%. So what's next for the second half of the year? Let's cover it in this video. Also, in terms of my options trading, I will be showing you how one can profit from both directions of a stock. So do stay throughout to find out more. Alright, the Wall Street struck off the fear of a US recession and stagflation as it recorded a solid first half of 2024, fueled by impressive companies' earnings and of course the AI boom. There have been lots of optimism in the market recently. Some investors believe that a soft landing by the Fed is getting more and more possible, while the others are saying that the Fed had already put off a soft landing. In case you don't know, the so-called soft landing is when the Fed is able to bring down inflation and eventually cut interest rates while the economy and companies' growth remain resilient. Thus far, I think the first half of 2024 has been following this script. In fact, the latest inflation reading gave further hopes that cooling price pressures will lead the Fed to cut interest rates as early as September. Basically, according to the latest PCE index, inflation in May slowed to its lowest annual rate in more than 3 years. The core PCE price index, which excludes the more volatile food and energy prices, rose just 0.1% last month and 2.6% from the prior year. Both estimates were in line with expectations. In addition, the headline PCE was flat on the month and up 2.6% on an annual basis, also in line with estimates. From the market's perspective, the latest PCE inflation report is positive, in fact, near perfect. Looking at the week ahead, it is going to be yet another holiday shortened trading week as the US stock market will be closed on Thursday for Independence Day. Prior to that, on Wednesday, the market will close 3 hours early, so do take note of that as well. On the economic data end, it's gonna be a slow week too. But a major economic indicator will come on Friday as the US Labor Department publishes the June jobs report. The strength of the labor market and unemployment rate will be something that investors and the Federal Reserve are watching out for. In the weeks and months ahead, investors will brace for what many expect to be the first rate cut by the Fed. The current forecast states that the first rate cut will likely arrive in September. But before September, we will see another FOMC meeting in July, specifically on 30th and 31st July, which the market does not expect any changes from the Fed. On a separate note, last week we saw on CNN the first debate between the current President Joe Biden and the former President Donald Trump. I believe investors have taken note of Biden's not so convincing performance. To add on, the former president's promise of tax cuts and trade clampdown could potentially be market-moving catalysts should he be elected as the next president. Let's now move over to the technical analysis portion, and we shall begin things with the broader market SPY. Okay, let's go straight to the point. I spotted 3 bearish signals on the chart. First of all, that red candle that was formed last Friday is called a bearish engulfing candle. Secondly, we have a bearish divergence appearing on the RSI. And thirdly, the MACD has confirmed a bearish cross last Friday. On top of these 3 bearish signals, last Friday's decline came with higher than average trading volume, and that's not a welcoming sign for the bulls. To add on, in my last video, I shared that once SPY cleared the 542 level, it will likely head towards 550's range. Well, it sort of did it, as it briefly kissed 550 during intraday, but lacked strength to go further up. It basically got rejected before hitting the next meaningful resistance at 554. For this week, watch that 542 support level again. If it breaks, I think it's just a matter of time for SPY to hit that gap area between 535 to 537. Okay, here's a caveat. Despite the 3 bearish signals, I must say that technical analysis is just an indication of what could be the next movement. It's all about probability. For example, we can say that there is a 70 or 80% chance for a bearish move this week, but the remaining 20 to 30% chance could still play out, right? My point is, stay nimble and stay adaptable to changes. So how do we know if the bearish thesis doesn't play out? First of all, that 542 level needs to hold. If it holds, then all is good. It's not that bearish for SPY. It could just be institutions locking in some profits last Friday as the month and quarter came to a close. With that, SPY may just continue to consolidate between this range of 542 to 550, which it has been doing for the last 9 trading days. I mean, it's a holiday shortened week, so the overall trading volume will be low and we are unlikely to see very crazy movements. That being said, for us to call it bullish, SPY has to go above this consolidation range by breaking and staying above the 550 level. But again, I would expect some resistance and profit taking at 554. Moving over to Apple. Apple looks like it is in the mini consolidation mode after its solid breakout from the 200 level. As you can see from the chart, for the last 12 trading days, it has been moving sideways between this range of 207 to 220. As shared in my previous video and also with a holiday shortened week ahead, I don't think there is any catalyst to move Apple above 220 this or next week. So this could be a trading opportunity. For instance, sell a covered call at 220 strike price. Okay, this is definitely not a trade recommendation and please be aware of the risk. For example, if Apple were to announce another AI initiative or partnership, who knows, the stock could moon past 220. Anyway, just watch for 207 for the downside and 220 for the upside. As long as Apple stays within these 2 levels, it's neutral. It's called sideways movement. But if 207 breaks, I think it could open the door to the key support level at 200. Okay, 200 is definitely one big level to watch as it has turned from a solid resistance level into a solid support level. And when a solid support level breaks, it spells trouble. But on the other hand, if Apple breaks above 220, the next resistance is 225. So if you have a covered call or a bearish trade on hand, if Tesla breaks above 220 and even 225, please consider your exit plan. Okay, that's just my personal view, of course. Let's now jump over to Tesla. Ladies and gentlemen, I hope my analysis in my last video deserves a like button, because in that video, I specifically mentioned that it may sound a little crazy to go against this bearish trend of Tesla, and I presented the potential bullish signals that I saw on Tesla's chart without bias, even when the overall trend was bearish. I specifically shared that we have a bullish double bottom pattern. For confirmation, Tesla needs to break above 187 resistance level. I also added that a breakout above 187 means we could touch the level 200. Well, Tesla did exactly that as it went above 200 briefly on Friday before getting rejected. Not just that, the so-called big movement of Bollinger Squeeze that I have anticipated 2 videos ago have finally been materialized. Well, I guess I was 2 weeks earlier. As you can see, the jump from the recent low of 167 to the recent high of 203, that's a whopping 21%. I mean, if you can't pick the absolute bottom and top, if you had managed to ride from the low end of this consolidation area where the Bollinger Band was squeezing at low 170s to say 200 level, that's still more than 15% pop. If you had bought low and sold it high, or had call options, your profits should be pretty decent. Anyway, so what's next? Well, quite straightforward. But before that, just wanted to say I'm not sure why the views of my videos have dropped drastically recently, although mine wasn't a lot to begin with. Anyway, I really wanted to take this opportunity to thank the 10 or 20 viewers that follow my videos almost every week. But wait, do I even have 10 viewers? Okay, if you are the 10 or 20 viewers that tune into my channel almost every single week, do leave a comment below. I really appreciate your support. A really big thank you for sticking around, and my thinking is that even if my videos only benefit that 10 to 20 long-term followers and viewers of this channel, I will be very happy, and I will continue to produce such weekly videos until of course certain things change in future. Alright, back to business. Come this week, once again watch that 200 level like a hawk. In fact, given how volatile Tesla is, I may want to stretch this level to 206. Why 206? That's because 206 is where the current 200 moving average is. Not just that, there is also this tiny weeny gap between 205 and 206. The last time round when Tesla traded above 200 moving average was about half a year ago. So if Tesla can reclaim this 206 level, I would say it's quite bullish because it will also reclaim the 200 level as well as fill that little gap. Alright, above 206, I would say it stands a high chance of charging towards 220 before the next meaningful resistance comes in. In fact, the moment Tesla hit 220, I wouldn't be surprised if FOMO investors start stepping in and push the stock price even higher. Okay, on the other hand, if Tesla gets rejected at 200 again, the next immediate support is at 188. But don't forget, this is Tesla, it's very volatile, so I think if there is a pullback, we can expect it to decline below the first Fibonacci support level. Below 188, watch for the 50 moving average at 176 as well as the blue dotted downtrend channel line. To add on to these levels, I would say the last line of defense in the near term is around 171. This 171 level somehow has been a decent support since early May. I mean, you can see from the chart, Tesla has been moving sideways above this 171 level for more than 1.5 months. Therefore, if this level breaks, I think we can say hello to low 160s. Let's now hop over to Google. Google's chart is actually one of the most straightforward ones as compared to many others. So in my last video, I shared that if MACD crosses up last week, we can say hello to another all-time high. And Google did just that. Then I also mentioned that if we want to see a real solid bullish momentum from Google, it needs to break out of this green dotted uptrend channel. And Google failed to do so, which means I wouldn't say Google is super bullish now. Just to add on, it had attempted to break out of this green dotted channel on 3 occasions, but each and every time, the breakout couldn't sustain and Google fell back into the channel. This means, despite the various all-time highs, there is a little bit of buyer's exhaustion at the moment. On top of that, there is a bearish divergence forming on the RSI. In short, if you are a bull, be a little careful this week. On the downside, watch for 178 as the first support level. If this level gets breached, nothing too concerning yet. The more important support level lies at 173. Because this is one level that Google has been consolidating and trading above since mid-May. Not just that, this level also coincides with the bottom end of this uptrend channel. Therefore, if 173 breaks, Google is bearish, as simple as that. On the other hand, the things to take note for the bullish thesis remains. Google has to break above this green uptrend channel. It needs to do it decisively and not the pick-a-bull type with 1 or 2 weak candles above it. Alright, moving over to Meta. My last video mentioned that if Meta can reclaim 500 level, that's good news for the bulls. But I would only say Meta is very bullish if it can close above 513. Well, Meta did that for one day, but it wasn't convincing. And then the very next day, Meta fell back below 513 again. So for this week, it's the same. Watch this 513 level. This level is the top end of this consolidation area that ranges from 482 to 513. A solid breakout from this area means we could see Meta testing the recent all-time high of 531 again. But the longer the share price stays below 513, the higher the chance it will head towards the lower end of this consolidation area, which means we could see low 500 again. If 500 doesn't hold, 492 would be the next support, followed by 483. To add on, a bearish divergence has been formed on the RSI chart, so be a little wary this week. Personally, I will only be excited if Meta goes back to low 480s range again. That's one big potential bounce area with the 61.8 Fibonacci level as well as the gap between 478 to 483 acting as a support. Again, this is one area that I would consider either picking up some shares or selling cash secured put. And oh, another thing to highlight, I have been talking about the MACD of Meta's chart. It just somehow does not cross down. This shows that Meta is kind of resilient at the moment. But it also means that if the MACD starts crossing down, Meta could easily break below 500 and move towards the low 490s range. Let's now check out Microsoft. Microsoft is really a beast. Remember I mentioned that when the stock hit all-time high, usually sellers will dry up a little bit and the stock price can continue to create more all-time highs. And you can see that from Microsoft chart. It's like it hit an all-time high, retraced a little bit but not much sellers were stepping in, and then it rebounded again to create another all-time high. So last Friday we had that retracement again. Does it mean we will see another all-time high this week? Honestly, I don't know, but there are some ways to look for confirmation. First and foremost, watch the support level of 444. If Microsoft can hold this level and continues to trade sideways above it, then it could slowly grind towards all-time high again in the short term. But if 444 breaks, to be honest, I don't see much support all the way to low 430s. From 444 to low 430s, that's actually a big drop in Microsoft's context. I'm not sure if that will happen, but to summarize Microsoft's chart, I would say watch this mini consolidation zone carefully, and the range is between 444 to around 455. One last thing to highlight, Microsoft also have a bearish divergence formed on the RSI, and the MACD is about to have a bearish cross. Note the words about to, so it's not confirmed yet. Watch it carefully this week. As for the RSI, I can't recall how many bearish divergences I have spotted on the various charts. It could be market makers taking profits last Friday in view of the end of a trading month and quarter. So this week's movement will tell us more if the bearish divergences is going to play out further or not. Let's now check out my option trades. Do stay throughout this section as I will share how I make money in both directions for the same stock. Anyway, there are 3 trades to update this week. The first trade is on Nvidia. Yes, I have finally traded an option on Nvidia. It is a cash secured put that was sold on 24th June last Monday with a strike price of $99 expiring 2nd August. Now let me share with you my thought process, which I hope it could be a useful reference for your future trades. So what happened was, for whichever reasons, Nvidia started to experience a sell-off on 20th June, Thursday. On that day, Nvidia fell 3.5%. It then continued to fall the very next day as the share price declined another 3.2%. And the sell-off continued on Monday, 24th June, where we saw the share price plummeted more than 6%. In total, that was a more than 12% drop across 3 days, pushing Nvidia into a technical correction, which is defined as more than 10% drop from a recent high. In the process, more than $500 billion of market value was erased. As a result, Nvidia's market cap dropped below $3 trillion and lost its status of being the most valuable listed company to both Apple and Microsoft. So why the sell-off? Well, part of the reasons could be because insiders were selling Nvidia shares. Check out this screenshot on X. On 20th and 21st June, when the share price started to tank, you can see that the CEO Jensen Huang and two other executives sold close to 450,000 Nvidia shares in total. As for 24th June, where it experienced the worst sell-off at more than 6%, I really couldn't find any reason. It could be people taking profits, or could be investors who got freaked out by the earlier 2 days of sell-off and panic sold their shares. Anyway, that was the day which I asked myself, have the fundamentals of Nvidia changed? The answer is no. Therefore, I was of the view that the massive sell-off was uncalled for and a rebound was imminent. As a result, I stepped in to open a cash secured put, which is a slightly bullish move. And guess what? Nvidia rebounded the next few days, and right now the trade is sitting on a nice 65% profit. In case you're not aware, I have some Nvidia shares which I bought in 2021. Therefore, I am not in a hurry to add more Nvidia shares at the moment. Okay, the next trade to update is this new cash secured put on Tesla, which was sold on the same day as the Nvidia's trade on 24th June, Monday. The strike price is $150 and the contract will also expire on 2nd August. The reason for the trade was briefly explained in the technical analysis segment. There were already some potential bullish signals prior to 24th June where I made that trade. So on 24th June, I saw Tesla open above the blue dotted downtrend channel line and was pushing above the 185 Fibonacci level and the resistance level of 187. As a result, I stepped in to sell a put. And then over the next 3 days, we saw 3 nice green candles forming on the chart, and the trade is currently sitting on a nice profit. Alright, so that was a trade which was leaning towards bullish for Tesla, where I would want the price to go up in order for my trade to profit. Now here's the third trade, which is the opposite of the earlier trade. This is a slightly bearish move where I want Tesla price to go down a little bit. And interestingly, yep, it's on the same stock, Tesla. Anyway, it is a covered call with a strike price of $200. This trade is a quick scalp and I would call it a volatility play. What happened was last Friday 28 June, I saw Tesla open very strongly as it got pushed above 200 within the first 15 minutes of market opening. When I saw that, a few things came to my mind. First of all, I am of the view that 200 is a strong resistance level. It was a level that we went close previously but didn't manage to go above. In addition, it is also a strong psychological level that sellers could potentially step in. But of course, this second argument could work against me as well. If buyers can reclaim this level, it will then become a strong psychological support and Tesla could stay above 200 for some time. Well, I don't have a crystal ball, so I don't know if that day was the day where bulls will push Tesla above 200 or not. But what I knew was that last Friday was the end of a month, a quarter, and the first half of the year. This means there will be portfolio rebalancing from fund managers and the big institutions, which also means there was a likelihood that we will see high volatility and whipsaw movements where stocks can have wild swings during the day. Therefore, the moment when Tesla popped to a certain level, I stepped in to sell a covered call. By doing so, I received a premium of $1,500, and without even looking at the chart, the moment my sell order got filled, I immediately placed a buy order for the same contract at $1,400. I mean, you can check out the screenshot. The time between the sell order getting filled and the time which I placed the buy order, the difference is only 20 seconds. The reason was very simple. I was of the view that volatility will bring Tesla back down again during intraday. And guess what? Within half an hour, Tesla retraced and my buy order was fulfilled. So this is what I called a volatility play. Anyway, the profit for this trade was $100, less trading fees. Well, that's more than 130 Singapore dollars in 30 minutes. I will take that anytime. Okay, just to add on, if you had realized, the second and the third trade were on the same stock, but they were profiting based on different directions. This also means that with some basic technical analysis knowledge, one can earn money in both directions via options. If you are new to options trading, please consider checking out my video linked at the top. And do stay subscribed to my channel for regular updates on technical analysis. Okay, some end thoughts from me. It seems like the fears of a US recession are from another universe, as the US stock market recorded more than 30 record highs in the first half of 2024, and many are expecting more gains to come. But of course, you also have a handful of investors who are of the view that despite a stellar first half performance, the recent wobblers, especially from Nvidia, have raised the question of how sustainable is this year's rally, and some are fearing for a bigger pullback sometime in the second half of the year. Okay, so here's my personal take. I think both scenarios could play out. Alright, don't get me wrong, I am not sitting on the fence, or maybe I am. Anyway, my point is we could see a significant 5% pullback in S&P 500 while at the same time still see the market charging to more all-time highs by the end of the year. Simply because the market does not go up in one straight line. There will be breathers, pullbacks and pauses along the way. But overall, as I have shared last week, the main flow of the market is bullish, and therefore I am leaning towards bullish. Just to add on, this story of optimism was also shared by many analysts and banks as they call for more records high later in the year. Major banks including Goldman Sachs, Citigroup and UBS this month have upgraded their end of year forecast for the S&P 500, as you can see from this screenshot. Personally, I love the market rally, but the only problem is it makes it very difficult for me to pick up the shares I want. I have not really been able to add to my existing positions for the last 2 months. Okay, maybe in recent months I only managed to add Salesforce at a very small amount. My entry price was $242 and it's now about $257. Anyway, all being said, I still want to do my usual reminder and caution investors from getting overconfident. I mean, it appears that many are thinking that the sky is the limit, especially when you look at Nvidia's run-up. And I think its recent 3-day sell-off serves as a small reminder that every stock and the market need a breather every now and then. So please keep that in mind and let's continue to watch the market with me in the second half of the year. So do remember to stay subscribed to my channel and of course help to tap the like and subscribe buttons before you exit. Thank you.